Seeing an opportunity beforehand ensures we live a comfortable life in the coming years. Let me tell you what I mean. Let me start like this. Last week, a client called me and said, "Tom, I've been investing for 20 years, but I'm still losing money. Where am I making mistakes?" I've heard this question thousands of times throughout my career. While working as chief equity strategist at JP Morgan for 15 years, and since founding Fundstrat, I've been hearing the same story constantly. To be frank, people don't lose money in investing because they can't pick the right stock. They lose money because they repeatedly make the same 5 deadly mistakes. Let me tell you a story. In 2008, while working at JP Morgan, there was a portfolio manager, very smart guy, Harvard MBA, 10 years of experience, but he constantly made the same mistakes. Eventually, it ended his career. This guy became a warning for me because I realized that on Wall Street, doing technical analysis and building financial models is easy, but avoiding psychological traps is the hardest thing. Today, I'll share with you the 5 major mistakes I've observed in my 25 years of experience that destroy investors' wealth. Wait. These aren't just theoretical, these are real dangers I constantly emphasize in my CNBC programs and pay attention to in my own portfolio. The first mistake I observed, trying to time the market. Now we're getting to the real issue because this is the most common and destructive mistake I see. Last month on Fast Money, an investor called and asked Tom, "Should I wait until the Federal Reserve cuts rates?" Let me tell you, this is a question heard daily on Wall Street, but it's a completely wrong approach. Most people don't know this, but trying to time the market is mathematically impossible. Why? Because for correct timing, you need to get both the sell and buy decisions right. The probability of making 2 correct predictions is very low. The most important thing I learned while working on Wall Street was time in the market is more important than timing the market. Let me share another anecdote with you. At the end of 2018, when markets were falling, a client at JP Morgan told me, "Tom, this time is different. The tech bubble is bursting, sell everything." The guy was managing a $1 trillion fund, very experienced, but fear had taken over him. I told him this is panic selling. Historical data shows the opposite. He didn't listen. When the market rose 30% in 2019, he was very regretful. When the pandemic started in 2020, I was constantly getting messages from my clients, "Tom, it will fall more, let's wait." But I said at that time, this is panic selling, it's an opportunity. Indeed, after March 2020, one of the biggest rallies in history came. Investors who waited missed this rally. What's interesting here is the cost of missing the market's best days is very high. Most of the S&P 500's annual returns happen in just a few. If you're not in the market on those days, annual returns drop dramatically. This mathematical reality shows how risky trying to time is. Analysis we did at Fundstrat shows investors who missed the S&P 500's best 10 days since 1990 lost half their annual returns. Those who missed the best 20 days earned almost no returns. And these best days usually came during the darkest periods when everyone was hopeless. And there are even more shocking things you'll hear. Keep watching until the end to see this. Second mistake, ignoring Federal Reserve signals. You'll be surprised to hear this, but 90% of investors don't follow what the Federal Reserve is doing. When I appeared on CNBC, the host asked me, "Is the Federal Reserve's impact exaggerated?" I said, "Absolutely not, because the Federal Reserve is the heart of modern markets." I've been in this business for 25 years, let me tell you. An investor who can't understand the Federal Reserve cannot be successful. Every word of Jerome Powell moves trillions of dollars of capital. When he uses the word patient, it's a dovish signal. When he says vigilant, it's a hawkish signal. Learning these language codes is critical. Let me tell you another story. When inflation started rising in 2021, Powell constantly used the word transitory. I told my clients at that time, pay attention to this language change. Indeed, a few months later, Powell dropped the word transitory and started saying persistent inflation risks. This language change was the first signal that the Federal Reserve would change policy. Investors who followed this could prepare 6 months in advance. When talking with my clients at Fundstrat, I constantly provide Federal Reserve education because this is fundamental knowledge. When I said the Federal Reserve would be hawkish in 2022, nobody listened. "Tom, you're exaggerating," they said. But indeed, the most aggressive rate hike cycle came. Investors who follow Federal Reserve cycles win in every cycle, those who don't constantly make wrong timing decisions. Here's where the real issue comes. The Federal Reserve doesn't just make interest rate decisions, it also manages market psychology. Forward guidance. Plot. Meeting minutes. Might. These are all future policy signals. Learning to read these signals means being 6 months ahead in the market. I constantly emphasize in my CNBC programs. In Federal Reserve meeting minutes, several participants noted means minority view. Many participants observed means majority view. Understanding these nuances allows you to predict the Federal Reserve's future policy. Now, the next important mistake I observed that I say should absolutely not be done is this third deadly mistake: making emotional decisions. To be frank, this is the most human but most expensive mistake. Fear and greed are an investor's biggest enemies. Let me tell you a story. In March 2020, when markets were collapsing, a client called me and said, "Tom, sell everything, it will fall more." I could hear the panic in his voice. I told him this is an emotion-driven decision, calm down, but he didn't listen. He panic sold. When the market recovered 2 months later, he was very regretful. The hardest lesson I learned while working on Wall Street was even the smartest people can make the stupidest decisions during emotional moments. Warren Buffett has a famous saying, "Be greedy when others are fearful. Be fearful when others are greedy." It's easy to say but hard to apply because it goes against natural human psychology. Let me give you another example. During the Bitcoin rise in 2017, a client had bought Bitcoin at the $19,000 level. Why? Because it was constantly in the news. Everyone was talking about it. The FOMO effect was very strong. He thought, everyone is making money, I should buy too. A year later, when Bitcoin fell to $3,000, he panicked and sold. Classic greed and fear cycle. I have strict rules in my own portfolio too. I never make decisions during emotional moments. I wait at least 24 hours. Most people don't know this, but the best investment decisions are made with a cool head. I constantly emphasize when I appear on CNBC, markets are driven by fear and greed, but wealth is built with discipline and patience. We did research while working at JP Morgan. Investors who made emotional decisions earned 3 to 4% less annually on average than disciplined investors. Over a 20-year period, this difference meant doubling wealth. Emotional investing works against compound interest. Wait, let me give you a shocking statistic. Analysis we did at Fundstrat shows that individual investors usually earn 2 to 3% less than their own investments. Why? Because they buy and sell at wrong times. They make emotional decisions. Fourth deadly mistake: holding too much cash. Wait, this is very important, because most people think cash is safe, but it can actually be the riskiest position. When the Federal Reserve is dovish, cash is trash. Why? Because inflation silently erodes your money. During the 2020-22 period, investors holding cash truly lost 10 to 15% purchasing power. Last week, a client told me, "Tom, the market is uncertain. I'm staying in cash." I explained to him, uncertainty is always there, but by holding cash, your opportunity cost is very high. Let me give you a striking example. After the 2008 financial crisis, many investors exited markets and started waiting in cash. They wanted to be safe, but from 2009 to 2020, the S&P 500 rose 400%. Investors waiting in cash missed this massive wealth creation. While working on Wall Street, I observed successful investors use cash as a tool, not as a parking space. They deploy it when opportunities come. They don't keep it idle constantly. According to analyses we did at Fundstrat, excess cash is the biggest enemy of optimal portfolio performance. Of course, an emergency fund is necessary. 6 months of expenses makes sense, but cash above that should be productive. Another client story: an engineer working in the tech sector was keeping $500,000 cash savings in the bank in 2019. "I want to be safe," he said. I told him this money isn't protected against inflation. You're slowly eroding. Finally, I convinced him we did portfolio diversification. When he came in 2023, we calculated, "Tom, what would the loss have been if I kept that money in the bank?" It was over $200,000 in opportunity loss. What's interesting here, investors holding too much cash think they're conservative, but they're actually taking inflation risk. You need to focus on real returns, not nominal returns. Fifth deadly mistake: entering at wrong times with FOMO. Let me tell you, FOMO is one of Wall Street's biggest traps. When everyone is talking about a stock, when it's constantly in the news, the desire to enter at the peak is natural but very dangerous. In 2021, when meme stocks were rallying, when GameStop, AMC were hitting ceiling, most of my clients asked, "Tom, should we enter too?" I constantly said this is speculation, not investment. Most people don't know this, but the most popular stocks are usually the riskiest ones. Let me tell you an unforgettable anecdote. In the 2000 dot-com bubble, a client had invested $100,000 in pets.com. The company was selling dog food over the internet, had never made profit, but everyone was talking about it. "This is the future," he said. The company went bankrupt a year later. The guy lost all his money. The thing I ask most when I appear on CNBC is this: why is this stock popular right now? If the answer isn't based on fundamental analysis, it's a red flag. I strictly follow this rule in my own portfolio too. I'm extra skeptical of popular narratives. Another example, during the crypto frenzy in 2017, people were mortgaging homes to buy Bitcoin. It will rise forever, they said. I said on CNBC at that time, this isn't sustainable. When Bitcoin fell 80% in 2018, most of those people went bankrupt. Warren Buffett has another saying: be fearful when others are greedy. FOMO times are exactly these moments. Here's where the real issue comes. The biggest opportunities are usually in assets nobody cares about, that media ignores. When I first gave coverage to Bitcoin in 2017, the same thing happened. Nobody cared then. Now there's an institutional adoption explosion. While working with my clients at Fundstrat, I constantly emphasize: when you feel FOMO, stop and ask why this asset is popular now. Real investment opportunities usually come quietly, they don't make noise. How to avoid these mistakes. Now let's discuss how to avoid these 5 mistakes. To be frank, completely eliminating these mistakes is impossible because they're part of human nature. But of course, minimizing them is possible. First, work in writing and definitely make an investment plan that way. Refer to this plan during emotional moments. Determine beforehand under what conditions you'll sell, under what conditions you'll buy. While working at JP Morgan, we prepared investment policy statements for every client. This document serves as a compass during emotional moments. Second, adopt a systematic approach: dollar cost averaging, regular rebalancing, disciplined risk management. I apply these rules in my own portfolio too. I invest a fixed amount every month. I rebalance twice a year. Third, definitely invest in education. Learn the Federal Reserve, understand market cycles, read behavioral finance. I read at least 10 finance books every year. I continue learning constantly. Fourth, find a mentor or get professional advice. Objective perspective is very valuable. Even while working on Wall Street, I constantly talked with other strategists, listened to different views. Fifth, keep a journal. Record when, why, with what emotion you made decisions. Pattern recognition develops. I constantly recommend this to clients at Fundstrat. In my 25 years of experience, I've seen this. The most successful investors aren't the smartest ones, they're the most disciplined ones. You can't completely avoid making these 5 mistakes. I even make them from time to time. What's important is recognizing and correcting them. Aim for improvement, not perfection. The most valuable lesson I learned while working on Wall Street: being right isn't important. Making money is. And to make money, avoiding these 5 deadly mistakes is essential. You'll be surprised to hear this, but success in investing is 80% psychology, 20% analysis. Technical skills can be learned, but developing emotional discipline is hard. What I constantly tell my clients at Fundstrat: control what you can control. You can't control the market, but you can control your behavior. By avoiding these 5 mistakes, you too can be successful in your long-term wealth creation journey. Because in the end, markets come and go, but correct principles always remain valid. Don't forget to like the video and subscribe to the channel to invest more intelligently and better understand the emotional aspects of investing logic.